Risk is sort of like energy, or you can't create or destroy energy. You can only change it. In the same way, you can't get rid of risk. You can only push it in time. Since we've been pushing this for such a long time, it's going to be really, really, really bad when it sort of finally explodes here.
Martin Sandquist is one of the 3 founders of the immensely successful hedge fund Lynx. In the late 1990s, Martin teamed up with 2 of his colleagues at the bank to form the trend-following, algorithmic managed futures fund Lynx. Over the next 2 decades, Lynx racked up over 500% returns and made each of the 3 founding partners into a billionaire. We cover a lot of ground in this interview, including Martin's view on cryptocurrencies, gold, and volatility. Listen closely and you'll find out how to get the bonus document with 27 of the most important lessons from our talk with Martin Sandquist. Here is the interview. Hi Martin, how are you?
Good, how are you?
Last time we talked about cryptocurrencies and you're quite skeptical. Could you elaborate a little bit on why?
I'm skeptical against cryptocurrencies, but I've sort of nuanced my view on blockchain technology, and now I actually think that blockchain is going to be quite disruptive in many ways. But I still don't think that cryptocurrencies or Bitcoin are going to be a viable application. I mean, I see blockchain as sort of an internet 2.0. I mean, we had internet, that was a decentralized way of sharing information, and I think blockchain is a decentralized way of keeping track of ownership. So I mean, that's a really good thing, but then we have applications on these though, like Bitcoin, and we have Facebook on the internet. But I mean, Bitcoin is supposed to be a currency, and the thing that doesn't make Bitcoin work as a currency is that you don't have a scarcity the way that they say you do. I mean, they say you only have 21 million Bitcoins, but you can fork them infinite amount of times and you can create as many altcoins as you want. So you don't really have scarcity, and you also don't have any intrinsic value in a Bitcoin. You have intrinsic value. There's value in the network, much the same way as there's value in Facebook, but you don't have that by owning a Facebook account, like the same way you don't have value by owning a Bitcoin. You can't do anything with your Bitcoin. So you don't have intrinsic value and you don't have scarcity, so it makes it very difficult to use as a currency. And it's not being used as a currency now, it's just used as a speculative asset because it's too slow and it's too expensive to transact in now. So it's lost all its purpose, and yeah.
I think what you're saying about the fork is pretty interesting, because if you look on Wikipedia, if you look on Forkster, they don't have a lot of good information. All they say is it's
just
happened.
A picture of a fork there.
Yeah, but it's like they're not. It's not going to give you an impression that that's something that can happen. If you look at the page, it's like it's happened, but it's no explanation of what it means or that it could happen again or why.
Yeah, and I've heard the explanation. Well, you know, it's just a couple of forks. It's not going to happen again. But I mean, who knows? I mean, they've forked it 2 or 3 times, like just last year. And some people argue, well, I mean, they create fiat currency much faster than that. But I mean,
even if they do keep forking, even if they fork 100 times, does that really matter? Since one of the forks, one of the iterations of the Bitcoin could be the winner. What they're doing is going through a Darwinistic process to find the best sort of Bitcoin.
Yeah, I mean, that could be the case, but then you don't know, how would you know which is the winning fork?
Oh, no, you don't. So you can't buy it now as a store of value.
Exactly. I think blockchain is going to persist and be a really interesting technology, but I don't think it's going to work by using tokens and miners that we have today. I mean, we have this new, I don't know if you read about Hashgraph. It's a new technology where you don't even need miners, you don't need tokens, you still have this blockchain network. So, and I mean, if you can relate it to internet, I mean, I think it's going to be the way we pay for internet. Today we pay for internet through ISPs, internet service providers. You pay a small fee and you get access to the internet. It's going to be the same way with blockchain. If you want to use an application for blockchain, you're going to pay a small fee, and maybe you'll have miners that compete for that fee in a pool or some way. But there's not going to be a need for a very expensive token the way it is today.
Your best guess of this is that even if you could pick the ultimate winner, that winner would still not have a significant value per
No,
per
I think
unit.
it might have a small value, much in the same way as, you pay a small fee for accessing the internet, but it can't be a huge value, I don't think, because of these things that we talked about. So,
Do you have any interest in investing in this like a so-called China trade, where like the saying goes that if you have a product and if 1% of the Chinese buy it, then it will be very valuable. Anyway, are you interested at all in putting any amounts at stake here in cryptos?
I would really like to invest in sort of firms that get involved with the blockchain technology. There's one firm in the US called Symbiont, which tries to identify technologies that are going to sort of try to take out the middleman, because that's where I think the big winning sort of aspect of blockchain technology is, where you can eliminate middlemen like banks and credit card companies, lawyers and exchanges, all these things that cost a lot of money that can be done more effectively through a blockchain technology. That's going to be very interesting. So firms that get involved in that. That could be. There are obviously going to be some huge winners here, but it's hard to say who they're going to be.
What's your view on initial coin offerings as a shortcut for venture capital?
Yeah, I'm not going to say that it's going to completely disappear, but there might be still some niche where you invest money and you get a token that you can use in that application. But when I invest in a company, I want to get part of their return streams, and that you don't get that by an ICO. You just get a token that you can use in their application. But there might still be some, might still be able to do ICOs, and there also you have all these hacks that have. I read that 10% of all the ICOs have all the ICO money that has been raised has been hacked and stolen. So that's not a.
I also think that the SEC is preparing a case against, I think, the largest ICO, since it's you're not supposed to raise money this way if they are considered equities.
How did you first get into finance? What was it that made you think that this is something for me?
I was always interested at a young age. I had charts plastered all over my wall, my boy room.
It's
walls.
pretty unusual.
but I can't explain where it came from. But none of my parents have this interest, and my brothers are all in film and movies or in the music. So I can't really explain why. Something has to do with the part of being financially independent and doing stuff on my own. I always loved to do stuff on my own and have sort of total responsibility. I always hated the sort of group work in school where we sort of had to share responsibility, and I played the goalie when I played soccer because I didn't want to have teammates. That's part of it.
Did you have a lemonade stand?
No, I wasn't that entrepreneurial type. I'm not really an entrepreneurial type, but I was always like the independence of trading, and also the fact that you're always judged by just the market. You're not judged by a third party, which is the case in most other occupations. You have to have somebody else evaluate what you're doing and have an opinion on it, and there's a third party evaluation. That's not the case in the markets where you're only competing against sort of this invisible market and yourself. And you're always getting judged day by day, and there's always also a direct correlation between your skill and the outcome. There's a lot of luck also and noise in the interim, but that's a really interesting part. That you can be a skateboarder or a great musician, but it doesn't mean that you're going to make a lot of money or be very successful because you have this sort of third party that's going to evaluate you. I see this all the time on the TV shows, and people sitting on the subways who are amazing musicians, but they might never make it because of luck and other factors. But so that's what I really liked about the markets, that there's a more direct connection between your skill and your outcome.
You've said before that you like looking for the truth and also making predictions, which, you need to know what the truth is in order to make predictions that work, that are practical. Did you understand this basis for trading early on, or is it something you've come to think of later on?
No, I think I sort of thought about that afterwards, and this sort of truth-seeking aspect really became apparent to me later on when I was getting interested in science and different kind of theories and all that stuff, and I saw the relationship with trading also. But it came a bit later on. As you mature, you understand more yourself and who you are. But
it seems to have entered other aspects of your life. So you're not you are looking for the truth in a more general sense as well. I'm thinking of books like The Fabric of Reality that you recommended, for example.
Yeah, exactly. I mean, but most of it is just my love for theories, and I mean, The Fabric of Reality deals with the theory of quantum mechanics, and I mean, we have two great scientific theories: the quantum mechanics and the relativity. And The Fabric of Reality deals with the many worlds interpretation of the quantum mechanics, where the Everett theory, where you have multiple universes all the time, sort of coming into existence to explain the sort of the strange behavior of quantum mechanics. So it's a very interesting theory, but it's very strange also. So
it's pretty far off from predicting the movement of a share price.
Yeah, exactly. But there's also, you're also trying to find truth in patterns, and I mean, prediction is a way to validate a theory. That's how you validate a theory. You make predictions, and if it's a good theory, it makes pretty good predictions. Maybe not 100%, but fairly good predictions, and so they belong together, theories and prediction, in that way. So
I would like to backtrack a little bit. So we have you there, like 15 years old, maybe, a boy with charts on its walls. How do you first get started with the market? Do you just like read the paper? And...
Yeah. It started like that. I read the papers. I saw all these numbers in the back of the paper, and I wondered what's that. That was interesting. And then when I realized that you could make money by predicting where these numbers are going, that made it even more interesting. So I started the usual way. I started reading about fundamentals, company reports, and my dad opened an account, and we bought some shares of some stock, and so that's how it grew, really. And I mean, I was really crazy at that time. I mean, people had posters of Def Leppard on their wall, but I just had charts on the wall, and people thought I was totally mad. What are these charts? But then you evolve. I mean, I realized that fundamental analysis wasn't really for me, so then I started to read about technical analysis, and that's where it really clicked for me, because I'm a much more of a visual person, and just technical analysis really struck a chord with me, and that's when I really knew that this was something I wanted to do. Then I didn't know about at that time that you could actually make a living from it. That sounds strange today, but back then I only knew of 3 occupations in finance. It was either you were a broker, or you were an analyst, or you were a fund manager picking stocks for a mutual fund. And I mean, I didn't want to do any of those. I just wanted to trade. So I thought I was going to trade on the side and have a real job as my main income. So, but then when I got to like 25, I realized there was this prop trading groups that you could work for, where you could trade for the bank, or you could start a hedge fund and all this. So that's when I really sort of thought that maybe I should do this for a living instead of.
How do you view fundamental analysis these days? Do you think it works?
Yeah, I think it's the wrong question to think about whether fundamental analysis works or technical analysis works. I mean, there are aspects that work and aspects that don't work. I use maybe fundamental analysis like 10% of the time. That's 10% of my input into a trade, and the other 90 is sort of pattern recognition and technical. But I mean, that's more because I'm not that good at fundamental analysis. If I was better, I would use it more. But I can't say that it's something works or doesn't work. It's more, it works if you're good at it. And I mean, there's 90% of technical analysis that doesn't work, so you can't say that works either. But it works if you become good at it and specialized at it.
This is really interesting, to become specialized at it. So you said you were more visually oriented. And this is something that you understood. Did you understand this at an early age?
Yeah, I think so. I mean, like I said, when I was 15, I started reading, fundamental analysis and company reports, and I just couldn't really get my head around it. I couldn't. It wasn't something that clicked in me. So it took some while. But then I found the technical analysis when I was 16. We went to high school, and a friend of mine pulled up in a Porsche. And I was like, so yeah, well, how did you buy that Porsche? Yeah, I use technical analysis. Okay, I want to look into that.
That's crazy.
So he really got me into that, and I started reading about it, and I just became fascinated with the patterns and everything. So
could you walk us through your process when you do research?
All sorts of approaches. I mean, I used Elliott wave analysis for a long time. I've looked at everything under the sun. But then after a while, I just started to recognize that some things didn't contribute to my predictions. So they didn't make any. I mean, even though I had spent like a few years on Elliott wave analysis, I was the expert. I mean, I knew everything. I'd read about it day and night. But after a while, I was just like, like, this doesn't add anything to my bottom line. It doesn't add anything to my predictions. Even though it's a great theory, I think it's valid in some sense, but it doesn't help me in my predictions. And then I have to discard it. And I mean, that's a really hard thing to do. And I still do that a lot. I have some favorite patterns that I just threw out the other year that I've been using for a long time. But after a while, I just realized that they don't work anymore. Something has changed. So I have to get rid of them and just focus on what adds to the bottom line. And that's, yeah.
I think there might be like a sense of being lazy if you use too few variables. And I think that's like a wrong that many fundamental researchers do. They want to add anything that might have even the slightest theoretical input into a model, and then they just keep collecting data series and never discard any series, especially if they on paper seem to be the most important, like sales or cash flow or price earnings.
Yeah, no, definitely. It's a hard thing to sort of, especially if you've been doing something for a long time and you're very, very good at it, and it's hard to sort of to kill your baby. Yeah.
What does that mean, by the way?
Elliott wave analysis.
Yeah.
It's a wave theory of the markets, which says that the markets proceeds in a series of 5 waves ups and 3 waves down. And it's a fractal pattern where you have waves within waves within waves, and you can sort of this is a framework where you can make predictions on how the market's going to go according to this theory.
And you can kind of always fit an Elliott wave to a chart.
Yeah. That's exactly that was my. It looks very good, and after the case, you can see. I mean, this looks like a perfect wave, but it was very hard to use it in real time and make predictions.
In theory, it also kind of holds water because it's mapped to human psychology, and therefore it's very easy to become a fan of Elliott wave analysis.
It's a fascinating theory. That's why I fell in love with it. But
you could probably fit the 5 stages of grief to the down waves, and then some other kind of positive on the upside.
But you've said before that it's very important to gain an edge, and so you realized you were visually oriented, and you also realized you like technical analysis. What did you do to expand upon that? Did you maybe come up with some systems to use this talent of yours, or practice it in different ways?
Yeah, I mean, I tried to practice it, and also try to come up with the things on my own. I've always been sort of a synthesizer in that way, that I read a lot about what other people are doing. I know you had a question about role models here. My biggest role model in trading is Linda Raschke. She's a trader in the Market Wizards, and I've modeled a lot of my approach based on her approach. Pattern recognition, where you sort of you try to find patterns and always revise your library of patterns to only keep those that are contributing to your results.
Is this someone that you know about, Mikael?
No, and I've actually read at least one Market Wizards, but as we discussed last time we met, Martin, I didn't like Market Wizards, but
You're crazy.
I'm guessing more and more that I should reread at least one of them.
I think she's in the new Market Wizards, the second book. She's not the biggest trader in the world, I mean, but she's really fascinating. And the case that she's a woman is also, there's very few women traders, and she's one of the best.
I also like to read a lot and synthesize. Do you have some process for doing it? Because for me, at this point, I feel like I'm becoming so much better at it all the time. And it's a really nice feeling. But it's becoming intuitive. But I have practiced it a lot. I've used all sorts of crazy learning methods and memorization stuff.
No, I don't have a method for it. It's I just try to be an infinite learner, or sort of a learning machine, and sort of try to learn all the time. And the fun thing about that is the compound interest effect that you have on learning. I mean, Buffett said that the compound interest is one of the greatest wonders of the world, and I think that's true. But it's also true in terms of knowledge and learning that. And I mean, you're still very young, Ludvig, so I mean you're going to be way smarter than us when you come to our age if you keep this learning pace up. So,
do you read with a pen or a highlighter in hand, or do you just read?
I read books.
Yeah, but when you read, do you do anything to remember?
I have my phone, so I write down on my phone if there's something interesting that I want to remember or do more research on. So I put that down into the phone, and I do. Usually I read it at night before I go to bed, and I also read a lot in the bathtub, like Alan Greenspan. So all my books are wrinkled and sort of destroyed because of all the reading in the tub. But I love lying in the bathtub and reading. That's my favorite.
Is it mostly to collect information and knowledge? Like, is this a directed activity for you, or is it more for entertainment, but you like things that are also contain information?
Yeah, I think it's a bit of both. I mean, I love learning things. I love it's fun to dive into a subject that you can have an opinion on. Talking at cocktail parties and stuff like that. But I have to admit, I have a bit of a bias. I think this is a sort of work hazard. And when you're in trading, you're always looking for the variant perception in the market. You're always looking for the other opinion that's sort of contrary to everybody else. That's where you can make a lot of money, when you have an opinion that's not in the price in the market. But this sort of spills into my other stuff. So I always love issues or sort of topics that where I can have a opposite opinion to the conventional wisdom. But my wife really gets annoyed at me. She's always like, why do you always have to have a contrary opinion to everything? So annoying. That's the fun part. I mean, it's not fun to agree with everybody. It's more fun to sort of have an opposite opinion.
How did you meet her? Did you ask her at a cocktail party what her favorite interpretation of quantum physics is?
Yeah, exactly. That was my pickup line. It didn't work too well, but
but this is something that everyone who's into finance and trading, they're like, okay, what's the magic formula for becoming a contrarian, right? But you have to, there is no formula, correct?
No, exactly. And I mean, it's not, you can't be a contrarian and you're going to make money by default. I mean, it's not that easy that you just can go against the conventional wisdom. Sometimes it's the best to go with the trend and the momentum and the conventional wisdom. But in the end, you have to have an opinion that's not priced in the markets, because otherwise it's impossible to make money.
What's your process of identifying whether you are going with the trend or against the trend?
Well, I have different momentum indicators and stuff like that. I'm always looking for sort of a shift in the regime, so a shift between volatility, low volatility and high volatility, because that usually begets trends. So when you have a period of high volatility and you start to see the volatility come down, you usually go into sort of a more range-bound non-trending market. And the opposite also, when you've had a long period of non-trending, low volatility markets, it's usually time for some kind of directional movement.
So for those who are not professional finance people, what are some popular or normal momentum indicators?
I use pivot points a lot. I use moving averages and breakout levels and stuff like that. But one of my favorite indicators is the ADX, the average directional movement indicator, which indicates just the level of trend in the markets. And you can see very, very clear cyclical patterns there where you have a low ADX for a long time. It usually is indicating that we're going to have some type of movement. And then I try to go with the momentum, and the opposite, when you've had a high ADX and it's starting to come down, it's usually a sign that we're going to go into some more sort of zigzag type of market. So,
talking of volatility, we are recording this just a couple of weeks after Volmageddon. You and I actually had a lunch booked the day after this volatility spike, and you actually canceled that lunch. Could you talk about what happened in the markets and maybe how that affected you?
Well, it didn't affect me that much. I mean, since I trade only my own money now, I can afford to just step aside and be fairly passive, which I did. But it was very concentrated in the equity markets, the volatility. We didn't have much FX volatility or fixed income volatility. So I trade a multiple range of markets, and equities are just one of them. So it didn't affect me that much. But it's very interesting that we see this pattern now. It's the same pattern that we had in 1987, where we had a lot of equity volatility, but not much volatility in other assets.
What happened then?
The crash of 1987. Oh. You were too young then, Ludvig.
It's the biggest percentage drop in the US stock indices ever in a single day. Dow Jones fell by 23% or so.
22%, something, yeah. So, I mean, we could be facing something similar to that now, and there's a lot of other similarities also.
This volatility spike, the VIX increased by almost 100% in just a single day. For me, the first thing I came to think of was the collapse of the Bear Stearns subprime funds in 2007, about a year before the financial crisis started. Do you see this as something similar?
Yeah, exactly. I mean, I think that's a very good analogy. It's that was in February 2007, much the same way this is February 2018. So yeah, it could be the start of something bigger, and I think it is. I don't think it's going to play out like 2008. I think it's going to more play out like the 2000.com bust or 1987, something like that.
So something more intense.
Quicker, exactly. But I think, this time central banks are going to jump in sooner and prevent a total sort of market Armageddon. But that's going to in turn ensue a currency crisis, like we talked about before. That I think that's my vision of how this thing is going to end. It's going to end in a currency crisis and a dollar crisis when central banks go back to easing and printing money again. Now they're on a tightening path, but soon they're going to have to give that up if the market goes down too much.
So is this related to your ideas about fourth turning generational cycles?
Yeah, exactly. It fits in pretty good with the fourth turning predictions that we're in a crisis period now, and the trigger was 2008, and we're waiting for the climax here. And like I said, I think the climax is going to be some type of collapse in the fiat currency system. Exactly how it plays out, I don't know, but I think, my bet is on gold, that you should have a lot of gold.
Do you think that what we are seeing in terms of quantitative easing the last 10 years, maybe in terms of a possible end to the petrodollar system and similar movements in the macro world, do you think those are postponing or pushing forward the fourth turning, or don't matter at all?
I don't think it matters that much. I think this would, central banks are definitely at the heart or the root of the problem here, which I think is very important for people to know. It's because I'm not afraid of sort of Trump or what he's going to do, but I'm more afraid of what's going to come after Trump and the socialist sort of socialist winds that are going to follow, because now everybody's going to blame this on capitalism, even though this is not capitalism's fault. This is the fault of central planning and central banks and government and on the meddling that we haven't had capitalism for a long time. The Fed has been sort of manipulating prices and markets for a long time, and they've tried to push risk out. And risk is sort of like energy, where you can't create or destroy energy, you can only change it. In the same way, you can't get rid of risk, you can only push it in time. And that's what they've done. They pushed the risk out in time, but sooner or later it's going to come back, sort of like trying to contain a volcano. You can just put a lid on it for a while, but it's sooner or later it's going to explode. And then since we've been pushing this for such a long time, it's going to be really, really, really bad when it sort of finally explodes here.
Since you mentioned gold, it's hard to carry. People want to steal it, and they actually can steal it physically from you if you have it on you. It's hard to hide or conceal on your body. It takes up space. It actually can be mined from the Earth or maybe an asteroid strike. And it's hard to use for small payments. Also, it can only be transferred in person. So how come gold is better than bitcoins?
Well, because now we have the technology to use gold. There's this firm called Gold Money where you can deposit your gold and you get a credit card and you can pay for everything and just deduct small portion of your gold. So now it's actually much easier today with the digital technology to use gold as money in real life transactions. And you mentioned that gold is heavy, it's hard to carry, but that's just the thing. It's the most portable money that there is. Everything else would be heavier, everything else would be more cumbersome. That's why gold has been money, because it has these properties, like it's hard to destroy, it's malleable, it's divisible, and has intrinsic value and everything. So
is there anything that competes with gold, like platinum or silver, diamonds?
They all have aspects of gold, but there's a reason why gold sort of has become money, because nothing is exactly like gold. Silver, as you know,
it oxidizes.
Oxidizes, yeah, exactly. There's a reason why gold has taken the top place there. But all the other metals are comparable. There's value there too, and you can use them in industrial applications. And gold would be used a lot more in the industry if it was cheaper. Now it's fairly expensive because of the monetary aspect.
So you said Gold Money. Is that Peter Schiff?
Exactly, he's invested in that. He merged his gold company with the Gold Money, I believe. So,
is your interest and investment in gold, is that like a 1% insurance trade, or is it something bigger?
It's bigger. It's like 10%, 15%, depending how you calculate. But I really think that the easiest way to play this sort of disaster scenario is just by going long gold. because you can't short the stock market because you don't know how much money the central bank is going to put in or how far they're going to go to save it. So the real play is just by being short fiat currencies and long hard assets, I think.
Do you think holding gold could just as easily double as it could halve in price? Is this just a way of parking money, making sure it doesn't disappear completely?
Yeah, exactly. I mean, I think that's it. It's a way of storing your value. And then, I mean, if you look at history, gold has been an excellent store of value. Like in the Roman times, you can buy a toga for an ounce of gold. Today, you can buy an expensive suit for an ounce of gold. So it's definitely kept this sort of purchasing power, which you can't say about any other any other currency.
All right. Going forward, no matter what it will mean in terms of dollars, do you think in 10 years' time, do you think you can buy more or less S&P 500 units or more or less square meters of living space for gold than you can now, more or less?
The living space is hard because that's a hard asset also, and I believe in owning sort of land and property. I think that's good. But I think the relationship to the S&P or Dow is going to, in all other crises, whether you go back to 29 or the 70s, we've always gone down to a Dow gold ratio of 1, which is, I think, where we're headed now also. I mean, the Dow divided by gold is going to be 1 or below that. So now we're at about 15 or something. It was at the peak of 40 at the 2000 peak there. So we've come down a long way, but it's still a long way to go, I think.
Oh yeah, speaking of the gold as a currency and retaining value, I read this really enticing sales proposition for cryptocurrency recently. And what they were saying was that you would have a hard drive where you would store your cryptocurrency, and then it would have a secret password, and then you would buy a cool ring and engrave inside the ring a special phrase that you would memorize like a secret agent. And then you would like go around and be location independent and take off your ring and open up your secret vault. And like when you read that sales proposition, it really conjured up images in your head like, I'm gonna be like James Bond.
Yeah, sounds very cool.
But the whole point is this is going to replace gold, and this is going to be the new thing where it's like everyone is just going to go around and be location dependent and have their secret storages of cryptocurrency.
Yeah, and I mean they play a lot on that in the crypto world. I mean they have the term mining for the proof of work in the blockchain, and sort of to say that it's similar to mining gold. I mean it could work if it wasn't the case that you could create as many of these cryptos as you want. I mean, and which people are going to do if the price keeps staying this high. I mean, the supply is going to overwhelm the demand sooner or later, and the price has to come down, because if it doesn't cost anything to create new currencies, then I mean, people are going to do it. So.
But one thing that's really interesting is just the psychological position of it, the psychological proposition of what's going on. So like, even if everything you're saying is right, you have a lot of people who have now started to become so interested in promoting this that they'll tell their friends, and because they're invested in it themselves and they have everything to gain from the price going up. So they've turned a lot of people into true believers who are very good salespeople, and it's going to spread like that. And even if there's no real reason, no real inherent value, that can make the price go up in a long period of time.
Definitely, and I mean, I'm not saying that this is over now. I think, I mean, there's a good chance that Bitcoin's going to go to 100,000. I don't know, but I mean, I think if we get a collapse below 3,000 or 4,000, that's going to be 80% correction. I think many markets, when you have that type of correction, it doesn't go back up. Now in Bitcoin, we've seen 70% correction a couple of times, and it's gone back up to make new highs. And now the recent correction was around 67%. So it might not be over yet. I mean, now we're back above 10,000, and I'm not going to say it's impossible that we go to 100,000. But again, sooner, I mean, the end game is that it has to collapse.
Yeah, I mean, you have a very different focus on this and the time horizon compared to like someone my age who's just trying to get rich quick speculating.
Exactly. That's what everybody's trying to do. It's just a speculative asset now. So
many who look at Bitcoin, they use variations of fundamental arguments, whereas since it actually has no intrinsic value at all, it might have a use case, but no real value. But your entire career is built on pattern recognition and analyzing the underlying psychology or the actual price movement. So your approach actually should work better here. From that perspective, you say that, all right, this correction was only 70%. So therefore, it might just as well set new highs. But just you wait and see until you get the first 81% correction. Well, it wouldn't be the first one. I think they actually had like 80 or 90% in the beginning.
Maybe that's true, yeah.
But since it became a little bit more mainstream, they haven't.
And now you have a lot more people that bought into it. I mean, before you had sort of hardcore, die hardcore fans that would never sell. That's why, I mean, you could have a 70-80% correction and people still didn't, they were just going to stick with it. Now you have a lot of people who are just trading it and have bought it at a lot higher levels who sooner or later just going to cash in and dump.
Whenever somebody says that it should trade at $100,000 or $1 million per unit, they base that on macroeconomical equations like MV equals PQ, which is just a way of saying how much of the economy should be traded in Bitcoins and how quickly. Or, for example, if Bitcoin is supposed to rival gold, then the price needs to be 500,000 or something.
But the reason I don't like to trade, I mean, I understand people who trade Bitcoin, but I would never do it because my type of analysis requires that there's a sort of a very large group involved. I heard that sort of like, I think a majority of the Bitcoins, or 50% or more, is held by only 1,000 people, which makes it's very easy to sort of manipulate, and I think there's a lot of that going on in the price when it's controlled by such a few hands, and so that makes pattern recognition not that great.
Do you know anybody who holds a significant amount of Bitcoin?
No, I mean, I have friends who have small amounts, but...
Do you speculate at all as to why, for example, the Winklevoss twins owns so much?
No,
what their play is?
I think they believe in it, and I think I can understand the case for it. People are fed up with the whole fiat currency system, and I think that the starting point for it was this sort of libertarian view that the central banks are printing too much money, and we're going to have the fiat currency doesn't work, so this is better because it's a scarce amount and everything. So. But I don't think they've thought it through the whole way.
I want to go back to the fourth turning theory. And there's one thing that I'm wondering if you've thought about. And so we're currently in this crisis period. And the reason we are in this crisis period, according to the fourth turning theory, is that you have these generational cycles. And when they come together in a certain mesh, then you get a very fast movement in the society. That's where things have built up over a long period of time and then they come crashing down. And my question here is, have you thought about how social media plays into this? Because that book was written before social media. And I have a little theory that it could either speed it up, which I guess is the first order thinking. And then if you think more, then maybe it is that maybe it doesn't speed it up, but it rather creates these like different niches who combat each other, and it doesn't speed up, but like those different niches kind of take it out, if you understand what I mean.
You're correct. I mean, somehow social media is probably going to play into it, whether it speeds it up or slows it down. I don't know. It could go either way. But I think it's interesting with the fourth turning predictions that you see so much of it sort of, you see so many telltale signs now of the fourth turning that we're in. One is this whole Me Too movement, I think is very telling, because one of the predictions of the fourth turning was that as you get into the fourth turning, you're not going to have time for sort of trials and due process, go to court and everything. And that's what you see in the Me Too movement. You have sort of summary convictions. People are getting, if you're accused, you're convicted right away. It doesn't matter what the truth is. It's just, it's a very summary trial fashion. And that's, I mean, in the fourth turning, you talked about the demand and supply of order in society. During the first turning, you have a very high supply of order and very high demand for order. The 50s and 60s, we came out of the World War II era. All the great institutions were created, UN and all this stuff. And then the second turning, the supply is still high, but the demand goes down for order. So you had the 60s, liberation movement, the women's liberation, and the sort of the flower power movement. So it's low demand for order, but still a high supply. And then in the third turning, you get low supply and low demand for order. You have the 90s, 80s, 90s with the deregulation and the freedom age, and the individualism and all this stuff. And in the fourth turning, you get still low supply of order, but you have a high demand for order. That's what we see now with the Me Too movement and everything. People want more order, they want more structure, but we have still a low supply of it. So that's what we're seeing now, I think.
Yeah, and I think one super interesting aspect of this is how most people, going back to what you were saying before about the importance of reading books, and I think a lot of people, they have a lot of shallow knowledge, but they don't have any strong patterns or models in their head. So everything seems new to them. And then because they do that, they think everything is new. And then because of that, they want people, some authority to simplify things for them.
Yeah, exactly.
And I think that's sort of what we're seeing social media do in a lot of cases.
Yeah, that's definitely true.
Maybe just because there is so much information available, you tend to focus more on the present, since even if all the information is available to you, there isn't room in your head for looking back more than a few years. I'm constantly surprised how new traders on the market, how little they know or remember of what happened just 5, 10 or 15 years ago.
Yeah, that's so fascinating, because in all other aspects of society, I mean, we always build on our knowledge. I mean, science and mathematics and whatever it is, we always retain the knowledge and we build upon it and sort of get further on. But in economics, it doesn't happen that way. We still make the same mistakes over and over again. I mean, fiat currencies have come and gone for many times, and politicians make the same mistakes, and voters make the same mistake over and over again. So it's very fascinating. But I think it's part of human nature. I mean, we're a short-sighted animal. So
I think that one of the best things with the internet and social media is that you can find your own peers very easily. I can find people that are interested in weightlifting and quantum physics, which 15 years ago, it would be pretty hard to find that special group.
It's a very, very small group. It's like 2 people. You and another friend.
And I have something else to add to this, and it's that maybe the generations, the archetypical generations in Howe and Straw's theory, that they find each other and they bond even more closely now that they actually know exactly what they think. So they find each other on Facebook or Twitter, and they just keep patting each other's backs and cementing the generations even harder together. And that could create an even more intense fourth turning.
Yeah, exactly. No, that's true. I mean, you have this, the whole idea of common knowledge. Everybody knows about private knowledge and public knowledge, but then there's always common knowledge, which is different, because that's when you know something and you know that everybody else also knows about it, which is the case with the whole Me Too movement. I mean, everybody knew that Harvey Weinstein was a serial rapist. I mean, that was public knowledge, but still nothing was done about it. Nothing happened until you have sort of a missionary that comes forward and has a good platform to speak. And everybody, when this person says this, everybody knows that everybody else knows about it too. And then it becomes common knowledge, and then it sort of just falls apart, everything. So
I think that's really what we're seeing a lot when it comes to politicians, or, well, not politicians, I mean politics, and how to question certain norms of society. That's something that's coming up there a lot. Do you think that history is a good way to predict the future, or a good way to learn from the past?
Yeah, I mean, with history is, I mean, it's all we have, really. I mean, we can only look at patterns in history and try to make predictions about the future. And I mean, but like they say, I mean, history it doesn't repeat, but it rhymes. So you have to always be careful not to extrapolate exactly, but you definitely can take some cues from history.
I think there is an interesting parallel here from David Deutsch, the author of Fabric of Reality. When he talks about scientific progress, he says that what true science does is not taking like historical examples and extrapolating. What it's doing is it looks at historical examples and finds an explanation. There's a big difference between extrapolation and an explanation, and the same goes for history, I think. And that's why it doesn't repeat but rhymes.
Yeah, exactly. No, that's true. And I think it's a very important point he brings up also there, that scientific theories not only have to make good predictions and good explanations, but they also have to be hard to vary. That's a very, very important part of scientific theory. I can have a scientific theory that, the god Zeus makes the spring come, because at this every time this year this spring comes, and it gets warmer, and then Zeus makes the winter come during the fall. But you can change Zeus for any other name, it would still be the same theory. It would still make good predictions because I have this timetable, but it wouldn't be a good scientific theory because you can vary it any way you want.
Exactly, and then if you just change places on Earth to another hemisphere, and then you can say, well, he's sad during winter time or something like that. You helped co-found the hedge fund Lynx. Now it manages about $6 billion. Could you explain, what do they do?
Lynx is a systematic CTA, it's called Commodity Trading Advisor, which uses purely systematic models to make predictions on the markets. So there's no sort of discretionary intervention from the managers. All that is done is construct models that try to make predictions, and then you follow the models 100%.
So how long would you say the lag time from constructing the models until you, let's say, change the models due to changes in the market?
It's fairly long. I mean, we had a rule that you should only change models every 6 months, and I think they still stick to that. So you want to make small incremental changes to the models and not be too sort of eager to change, because it's very easy to change a model just because it's had a bad period, but usually that's the wrong time to change a model because it's going to start to perform again. So you want to be sort of slow moving and but still adaptive enough to pick up in changes in sort of big structural changes that come along.
The reason I'm asking this, I heard something quite annoying the other day in the media. The journalist was critiquing Lynx for not reacting in a sound way to the Volmageddon event, which is completely ridiculous if you know what Lynx actually does. And also, I just looked back at your history, and since inception, Lynx is up by about 500%. And the market is up by about 100%. And yet, just one poor month and a very weird way of interpreting it made the journalist question Lynx's existence.
Yeah, and I think this goes back to what you said before about the short-sighted nature of humankind. I mean, we really have a sort of recency bias where everything that's happened the recent month or the recent year sort of has a bigger weight than everything else, and that's a very bad bias to have if you're in the financial markets. Because you're going to make very wrong predictions. One
of the things they said was that Lynx has claimed that it's the low volatility environment that's bad for them. But now you get high volatility, and that's bad as well.
I think it's a fair point that they make because I mean, CTAs and trend following are supposed to make money when the volatility goes up. Now in this case, it was the stock market volatility that really exploded, and the trend has been so strong in the stock markets. So a lot of the models are just positioned for being long equities. But that's, I mean, if this persists, which I think it will, I think we're going to have going forward, we're going to have a more high volatility environment. I think, I mean, CTAs and funds like Lynx are going to do well. But you never know. I mean, it's that's what I think. But I could be wrong.
Are gold futures something that Lynx invests in? Is that a market that's included?
Yeah, they trade gold, metals, commodities. Not a huge weight. I mean, financials are big, have a more weight, fixed income and currencies.
But what kind of time frames do you usually think about or think in terms of?
I'm a bit, in my trading, I'm a bit more short term. I mean, the longest is like a few months holding period. So, but I don't look at sort of, I really don't, I'm not super short term, so I'm not in and out every day, but a few weeks to a few months like that. Yeah.
How about documentation or self-evaluation? Do you analyze what you do and like have some process for it?
Yeah, that's a very important part of what I do. Every month I have a log where I track the P&L of my trading every day and the risk I have every day. And at the end of the month, I also write down mistakes I've made or things that I've done right, and then every month I sort of summarize it in a summary sheet, and then I reset everything. So I start from scratch every month and begin the process all over, and then and sometimes I go back to the summary page and sort of review what's happened, what's gone right and wrong.
And do you have an example of a situation where you diverged from your normal rules and guidelines and that turned into a failure?
Yeah, I mean, that happens all the time. You make bad decisions and you realize afterwards, I mean, you think, well, why did I make that decision? And usually it's some sort of combination between the FOMO, fear of missing out, and emotions get involved, and that's really when you typically make mistakes. And since I'm a discretionary trader, I don't just follow rules. I mean, I interpret the patterns, but you just try and learn from them and move on. But I mean, I make roughly maybe 10 trades a day, and I'm right about 60% of the time. That means that I have about 80 bad trades a month. So I mean, you have to learn to live with bad trades.
hopefully most of those 80 are still part of your due process and not due to bad decisions. No. I think that it's a very important distinction to make between bad decisions and decisions with bad outcomes.
Yeah, definitely. And then I know that when I have a bad trade, if it's because of a bad decision or it's just the numbers playing out. So.
But when you feel either uncertain about something, like you kind of want to do it, but you're not sure, something feels off, or if you really feel that fear of missing out, do you have someone that you can call, maybe a friend who is also good at trading?
No, I don't really have a network where I talk to people about trading every day. I don't really like that. It goes back to what I talked about before. I want to do my own thing and do my own analysis. I just get distracted when other people get involved with their sort of vision or their ideas. So. Sometimes I use people as a contrary indicator. You can listen to CNBC a lot, where there's a lot of good people that you can listen to and do the exact opposite and make a lot of money.
and we had lunch the other week.
Yeah, so Mick is my favorite contrary indicator.
So you're like but you're like a lone maverick.
No? Yeah, exactly. I'm more of a lone maverick. And I listen to a lot of opinions, but I don't really call out to people and ask what they think.
You can't have been happy when I got in on the gold trade.
Exactly. Oh no, it's all over now.
You have to change your whole...
No, I'm just kidding. I respect your opinion a lot, Mika.
I want to go back to the monthly analysis of yours. Is this something that you've been working with like for a really long time? Or is it something, so I mean like it crystallized over a long period of time and you've been refining it? So maybe you started out years ago with like and evaluating 20 things, and then you realized 20 were too much. And then you kind of found that maybe 5 things to reflect on were enough.
Yeah, no. It started out basically before we started Lynx. I started building up a sort of a library of patterns and methods that I like to use. And when we started Lynx, that became the basis for me building models. So I tried to use those insights and patterns to build systematic models on. And then when I quit Lynx, I've used the same library to make discretionary decisions. But I'm always refining the library and always trying to find new patterns. A lot of my, maybe 30% of my time is just spent doing new research and finding new patterns and trying to find new stuff that works. So that's the most fun part.
Is that how you get new trade ideas too?
Well, trade ideas usually come from my existing patterns that I know, and that's another third of the time that I probably spent just looking at the markets and trying to analyze and seeing how the big picture of the puzzle is forming up. And when I get confirmation from many different sources, many different patterns and signals, I enter a trade. But
does data mining play into this?
No, not really. When you build models, you're data mining, and I do some back testing also on my patterns that I use now. But it's fairly. I don't go back that many years like I did when we built models at Lynx. It's more like a couple of years, and then I do a lot of just visual inspection of the pattern. I just go back and look at charts and see how it's done. So it's
data mining to me. It kind of sounds a bit like extrapolation, whereas identifying patterns a priori and then back-checking, that sounds more like explanation. If we use
that's a much better way to do it, because otherwise you will always find spurious patterns that really don't have any predictive value, just because there's so much data. So the patterns are going to pop up that don't really matter. So it's better to have an idea first and then go back and check it. But that being said, there's a lot of new machine learning algorithms that try to deal with this overfitting problem, data mining problem. You have support vector machines which try to find the largest maximum margin between your errors and your predictors. So there's a lot of techniques that try to get to the heart of this problem with data mining.
How would you advise just a normal person with let's say like a half a year or a year's worth of salary in financial assets? How would he best invest on the markets?
It's a hard question, because investing is a hard thing to do if you want to make money at it. It's sort of like anything you want to do that you're going to make money at, you have to probably put in a long time and put in a lot of work to make it happen. You can't just sort of do brain surgery on the side and hope to make some money. But it's the same thing with investing. But I think everybody should own a bit of gold and stuff like that. But it's hard to give generalized sort of
so if you're
advice.
like let's say 40 years old, you have a traditional knowledge worker job, you're not willing to put in more than maximum 1 hour a day in managing your financial assets. Should you just buy like an all-weather portfolio?
We had a bull run now for a very long time, and I think that's going to change. So it's not going to be that easy. And I think the risk parity trade is almost over also. So I don't think all weather is going to do, very well. We have a situation now where we have extremely overvalued stock markets and we have extremely low interest rates. And the all-weather portfolio, as most know, is basically a long stock strategy with a leveraged bond portfolio. And that's worked really well as long as you have a negative correlation between bonds and stocks. But we could see a situation now where we have a positive correlation where stocks go down at the same time as bonds, and then that portfolio is really going to get killed. And add inflation to that mix, and you get a really, really big problem.
So maybe just own your house and some gold.
Exactly. That's my base case idea. If you know, if you have some ideas about companies that you know have some insight into, friends who have started and you believe in them, you can invest sort of in that stuff. But I wouldn't recommend people jumping into the stock market now. But yeah, owning your own house, owning land, I think is good also. If you look back at generations, the only way that generational wealth has been kept has been by property, people owning property, because all else has been sort of squandered. So if you look at the big dynasties, they're only the ones that have persisted are the ones that have had a lot of real estate.
So even if you don't regularly discuss your own trading with other people, who do you discuss these things with? Long-term views of the world?
Well, I talk to friends, but not everybody's that interested in these kind of things. So my wife definitely, she's pretty tired of me going on about gold and everything. But
I guess the same goes for books. You're quite an eclectic reader, and the books you recommended, I thought they were tremendous, and I've read quite a few of them by now, but they're kind of tough.
Yeah, they're not all easy reads, but I had some new, actually. You asked about the books. I had some new ones that I read. I don't know, have you read Principles?
Yes.
So that was a really, really good book.
I both read it, both the last version and the new version, and I also listened to it as an audiobook. It's great as an audiobook. I don't like audiobooks usually. I think they're terrible to listen to, but Ray Dalio actually reads it himself, and he does a really good job.
Yeah, no, it's very fascinating. Bridgewater, obviously the biggest hedge fund in the world, and they've made the most money for their clients of all hedge funds. So, it pays to listen to him.
I was actually going to recommend that book to you, since I think his principled way of approaching the world and problems seems like a perfect fit with you.
Yeah, I've actually modeled a lot of my trading after Bridgewater. They have this idea of putting together multiple alpha streams that are uncorrelated, and that's the way I try to do my trading. I have a lot of portfolios that are uncorrelated and have different approaches, and that's the way you get the best sort of risk-adjusted return. So I modeled myself sort of after Bridgewater a bit. But have you read The Grit? Yeah. One book I have to read that I haven't read yet is Fed Up, Danielle DiMartino Booth.
Yeah, I'm following her on Twitter. I think she's great.
Yeah,
I've also listened to an interview with her, but I haven't read the book.
What's this?
She's been on the Fed. I don't know if she's a board member. Yeah, but she's really has some good insights, and she really has a clear view of what's going on there and how clueless basically central bankers are. We put a lot of faith in these people, and they don't really know what they're doing.
It's to the point where it's unquestioned, right? Where we're not even thinking about it. It's just unconscious. It's just happening unconsciously because it's gone on for so long that it's tradition now. Yeah. And no one's really questioning it.
Yeah, exactly.
Are there any other books?
There's one, I don't know if I recommended this last time, but More Money Than God. Did I mention that?
No, I don't think
it's it's the best sort of summary of the hedge fund, of history of hedge funds going back to the 60s. It's really, really good. It's just a sort of, it just goes through the whole evolution of hedge funds and all the big players, and it's really, really interesting.
Is it a bit like Market Wizards, the hedge fund?
A bit like it, but it's not divided into chapters where every hedge fund has its own chapter. It's more sort of a narrative of the whole evolution and it's he really writes really, really well. Another one about Soros is actually it's hard to find, but it's just called Soros by Kaufman, and it's the best biography I found about George Soros. It describes with detail, I mean, how his whole personal life, and he grew up, you know, in the World War II, and then he had to flee to England, and his breakup with Jim Rogers, and all this stuff that you want to find out about, but nobody talks about it because it's hard to get some info. But
how come it's hard to find? It's not on Amazon?
No, it's not on Amazon. But I have it, so I don't know where I got it. But
it sounds a bit like margin of safety.
Yeah,
like
exactly. It could be, but it's fairly old. I think it was written in the 90s. But another good book is the Warren Buffett's Ground Rules. Have you read that?
No.
Is that a new book?
No, it's a few years old, I think. But it's about his earlier years, his Buffett partnership years from 56 to 69, where he manages more like a hedge fund, and his approach with these three different types of stocks that he bought: the generals, controls, and workouts, which are three different type of approaches that he used, and it's really fascinating.
I'm a bit surprised, actually.
Yeah, I mean, I'm not a value guy, so I couldn't. It's not really something that I could use in my trading, but it was fascinating to read about him. And you have to be impressed by his track record, obviously. But back then, he was, like I said, more operating like a hedge fund. Then in later years, I think he's more been a sort of just a puppet or a sort of cheerleader for Goldman, and the sort of the whole establishment. So.
Maybe you have to be with a couple of 100 billion.
Yeah, exactly.
You have to be the establishment if you are the establishment.
Yeah, exactly.
What did you learn from Soros? Because I know you read a lot about him. And I also remember from our former interview when you recommended 15 books. And you also mentioned Soros and that you have his table. You have his book on your nightstand.
Yeah, no, that's one of these books that I just go back to and read every once in a while. Partly because of motivational reasons. When you have a rough time, you go through a rough time, and you sort of go back and see how he did. Because he has this real-time experiment in the Alchemy of Finance where he talks about his trading in real time, and it's really just informative to see how he got through the bad times. But the most interesting thing about Soros, I think, is his take on why the whole name Alchemy of Finance, where that comes from. Mm-hmm. And I mean, his whole thing is that analyzing the markets and trading and the finance, it's not science. It's not a scientific approach, because you can never find the truth. It's more like alchemy, which the difference between alchemy and science is that in alchemy, you're just trying to get operational success. You're just trying to achieve something. You're trying to achieve turning base metals into gold or precious metals. And it's the same in trading. You're not looking for a truth or something. You're just looking for an operational success. And that's why it's more alchemy than science.
That's interesting. I have to read that book.
Yeah, so it's a really, really good book.
I actually said during the first week on my first job that I'm good at understanding patterns. I'm good at identifying them and using them. And then I spent 20 years in the finance business almost burning myself out because I couldn't find the patterns or the truth. I think that's part of why I eventually quit.
Yeah, exactly. It can be very frustrating, especially like me, if you like looking for truth and you're a truth seeker. But you have to realize that finance and trading, and it's more about trying to find something that works. And if something is not working, you have to change and you have to adapt. And it's like he says, he's not looking for rules; he's just looking for changes in the rules of the game. And it's.
And he has a very historic approach, correct?
Yeah, I mean, he analyzes it, but he's more a fundamental guy, macro guy, and I mean, I don't use that much, but he analyzes the economy and stuff like that. He doesn't use technical analysis that much, but
I remember reading some quote from him, and one thing that he said was that he studied a lot of history and he studied a lot of the main institutions in the world, like the EU, for example. And he knows, like, okay, it was founded this year and this year, and this is how this rule came to be, and this rule was created due to these circumstances. And so now those circumstances no longer apply, and people don't realize this. So this is knowledge that I want to use somehow. Yeah, like that's kind of how he approaches this, from my understanding.
Yeah, he's very detailed and goes into sort of very sort of arcane details about taxes and stuff. And he puts on a trade because there's some new tax law, or he's going up in the lift in Gestad, and he reads about British guilds, and he buys guilds when he jumps off the lift because he read something in the paper. It's sort of, but that's what's so funny about it. It's very sort of a stochastic trial and error approach that he has, but it seems to work.
Like he'll bet on anything.
Yeah, his saying is always invest first and investigate later. So you first make the trade and then you do the investigation. But like he says, it seems to work over time. But yeah, it's very
as long as you start small, I actually think that is a good idea. We often did that at Futuris, but with a very small starter position, it kind of hones your mind. You just open up to information about the investment once you've done it.
Yeah, exactly. That's true. But you also have to get rid of the sort of the bias that comes with owning a position, and you have to sort of be able to let it go easy. But he's the best loss taker there is. I mean, he could get rid of a position even after being on TV saying that dollar yen is going to go through the roof, and the next day he was selling it because he just changed his mind. So,
but I think what you're saying, Mikael, about what you just said, I think you could draw a parallel to war, where generals they see so much action that they get so much feedback that even if they don't start out as very smart people, they get so much faster and more serious feedback than other people that they become very smart because they take action with a lot of serious consequences and have to adapt to that. I want to go back to the way that you work, kind of like a lone maverick. Like, do you really work alone?
Alone.
I don't mean it like that.
How can you work alone?
No, I don't mean it like that. I mean, you have the opportunity to hire people, but you choose to do everything yourself.
Yeah, but
he's the supreme being. What would you expect?
No, but I really like being alone. I think a lot better when I'm alone, so I don't like a lot of distractions. And a lot of what I do is not really, it wouldn't be considered work. I mean, I spend a lot of time just looking at YouTube videos and researching on the internet. It's like, but it's. We talked about this before. It's like an analogy with training. It's like when you do workouts, it's when you're doing the workout, you're breaking down the muscles, and that's where you're doing the damage. But the whole positive thing comes when you're relaxing and just lying, and that's where the muscle starts to build. That's where you're doing the building process. Same thing with intellectual work. I mean, you could do a lot of research and look for stuff, but it's really just when you relax that the ideas come to you, because that's when you are open to them.
How much time per day or per week would you say is purely market related?
It's hard because it's like it's all the time, but at the same time I'm not sort of looking at the market all the time. But I always have the alerts on, so I know when I need to do something. And since I trade the US stocks up till 10:15, and then the currencies trade all the time. So, but I mean, I think, like I said, maybe 30% of my time goes to just analyzing the markets and trying to find trades, and then 30% goes to finding new patterns and doing research, and then 30% goes to sort of administrative work and keeping up with the P&L and stuff, boring stuff like that. But
so, do you get a lot of your ideas when you're relaxing in the bathtub?
Yeah, definitely. I mean, that's when I get the best ideas.
Do you think that you've built up an association? Because you've had like behavioral conditioning, where you just repeat something over time and you get rewarded for it, and then you've had many ideas, so your brain starts to believe and have an association that you will be more creative, specifically in the bathtub.
I think it's more like you relax and you sort of put together dots that you think were apparent before, and you have to be sort of a relaxed state to make the connections. Right. So I think it's more that, but.
So it's kind of like meditation.
Yeah, exactly.
I guess some of your life has been directed, conscious. What chance events have led to where you are? What coincidences?
Well, I mean, there are obviously many. I mean, the biggest one was definitely meeting Jonas and Svante. Without them, I mean, nothing. I wouldn't have created Lynx on my own. I mean, we needed the three personalities to make it work. I mean, I was the creative one, the one who had sort of ideas about systematic trading, but then we had Jonas, who was the sort of smart guy, the quant guy who could program and build the sort of mathematical basis for it, and then Svante was very good at leadership and all that stuff. So we needed all three parts to make it work. And that's also maybe one of the biggest challenges of that you have to stay long term, because I had a lot of offers when we just set up the firm and we were doing trading at Norbank, and to go to another firm and for bigger pay and better bonuses and everything. But I knew that we had something special, that if I just stuck to this constellation, that we could produce something great over time. But it takes you have to be sort of resistant to the short-term allures.
I would consider that resistance a conscious decision.
Yeah.
But apart from meeting Jonas and Svante, before that, are there any other interesting coincidences in terms of, for example, what you studied or where you lived, or I don't know, maybe when Lynx hooked up with Brummer and Partners?
Yeah, I mean, there's always a lot of coincidences on the way, and you have to be a bit lucky. We were lucky that sort of our initial ideas worked, and we had some new insights that weren't used in the CTA business when we started out, so we could outperform the CTA group. But the only thing I can think about is the guy driving up in the Porsche, and then I started getting interested in technical analysis, but we only talked about that.
Funnily enough, my classmate and main bully, that's exactly how he got me hooked on Stockholm School of Economics. He said the kids there, they drive Porsches. And I didn't even know what a Porsche was, but I could hear in his tone of voice that that's probably something you should have.
But so there we have you and Svante and Jonas, and you become sort of like a dream team within finance, and you start this really successful hedge fund. But if you just look at the dynamics between the three of you, do you think there are any lessons for other people who want to like create a dream team in finance?
Well, I think it's a very important lesson that you have to find people that complement you and are good at other things that you are. So I think we were the perfect mix of all the things that you need to be successful. And I think neither one of us separately would have done as well as we did. It's a matter of 1 + 1 + 1 becoming more than 3. I mean, it's really, and I think that's a good lesson for everybody who wants to start a firm or do anything. That find people that are good at things that you're bad at.
And I think this is really interesting from a business dynamics perspective, because it used to be before that different other things were important, but now as we're going into the future, it's becoming a really, really important skill set. And the value is shifting towards these kind of soft values, like putting together a team and understanding how to do that. This is becoming more and more important because fewer people can have more leverage with their work using computers and working in small teams. Like you yourself can manage a lot of money, which is, you can be very productive all on your own. But you couldn't have done that 20 years ago, right?
No, exactly. That's true. But I think that's sort of a ground recipe for success in anything. There are 3 things you need. You need to find sort of a specialized, something that you're really good at, and specialize in it and become really good at one thing. And then, like you said, you have to use leverage. If that is, in the finance, it's obvious you can use leverage by using futures products and stuff like that. But it can also be like just hiring people and building an organization and getting leverage that way. It's the difference if you're a nurse or if you're developing a new cancer drug. I mean, the payoff if you develop a cancer drug is going to be much bigger, because that's such a leverage effect, and just a nurse can just take care of one person at a time. And the third thing I think is that you have to stick to your thing and be really gritty and sort of, even though you have adverse things happening, you have to just stick to your core.
In the book Principles, Ray Dalio, he almost naively describes how he bought one computer, and that was like the essential tool for his outperformance. And then he says, and then we earned more money and we bought another computer. Do you remember that?
Yeah, no, I don't remember that.
It's kind of funny, but I think it has an important message in terms of use tools and use more and more advanced tools, and use tools to build upon tools and build new tools.
Yeah, exactly. No, I think that's very true. And I think that's, in a more broader sense, that goes back to people always say that you have to look at, sort of try to find the opposite opinion of something. I had a friend said, hey, we should really read more about communism because you never know, that might be good. But I think knowledge, if you want to build knowledge, you have to build it on previous knowledge. So you have to keep on building. So you have to set axioms that, like, well, I think capitalism is better than communism, so I'm not going to study communism anymore. And you go on and you learn more about that. So I mean, yeah, it's the same thing there. You have to sort of build on knowledge, and then yeah.
So you kind of find something that you believe is true, and then you build upon that.
Yeah, even though, I mean, you always have to sort of question your beliefs, and sometimes you have to totally unlearn what you've learned to go forward. There's something about naivete that's pretty amazing also. I mean, I don't think the Klarna guys would have started if they listened to all their teachers who said that you can't do this. So you have to sort of be a bit naive to start to be disruptive in any industry.
What's the worst thing about your life?
The dog.
The dog. Yeah, you have a new dog. How old is it?
No, it's only 4 months, but it's more of a hassle than we thought.
I think it's good for you to get up in the morning.
Yeah, I think it's generally I tend to get stuck in front of the computer, so it's good for me to get out every hour or so to take the dog out for a walk. And I think now I'm getting used to it now, but in the beginning it was quite.
I often tend to get ideas when I get up from the desk and go to the bathroom or take the dog for a walk. So I always need to have something to take notes on.
Yeah, that's true. But otherwise, I try to eliminate bad things. That's my whole philosophy, to just try to get rid of the bad things, and then the good things will take care of themselves if you just do that. So
that's kind of how you approach your trading too, principally, correct?
Yeah, exactly.
Where you want to remove the risks in as many ways as possible.
Exactly, and if you do that, the returns are going to take care of themselves.
Could you give some examples of how you've learned to do this? Because I remember in the last interview you said you gave a couple of examples, and one example that I vividly remember was that you avoid everything having to do with Bank of Japan.
They have a tendency to do things overnight, which can, if you're not awake, then it can be. I remember sometimes when we did prop trading at Norbank and the Bank of Japan had done something overnight, and we had lost a lot of money just because they drove the dollar yen, a few big figures. So you have to eliminate all the risk. You can't eliminate the risk completely because you have to take risk to earn something also.
But how do you think about that? Do you have different ways of categorizing the risk? So you're like, okay, now I'm going to focus on minimizing this aspect of risk.
Well, I just try to. One is just keeping the value at risk or the risk in the portfolio at a pretty constant level, so I don't exceed that. So I stay within the sort of what's reasonable. Then value at risk is not perfect, as we talked about before, but another thing is just trying to make as many multiple bets as possible, so that no one single bet or decision is really that important. It's more and more if you get the average right, and I've made over 10,000 trades now, and I've been about correct 60% of the time. And if you can do that and keep the losses and the wins around the same level, you're going to do pretty well.
What do you wish people in general did more? Not for your sake, but for their own sake. What do you think people do too little of?
They learn too little. I mean, I think people should learn a lot more. Try to be infinite learners and learning machines, and try to set aside more time to just reflect and not get too caught up in the sort of the day-to-day life with to-do lists. And I have a rule that I only spend like a certain amount of minutes every day on my to-do list, which is fairly long usually, but it's very easy to just get caught up in doing stuff, trivial stuff that might seem important now but aren't really important for your long-term goal.
Do you meditate in the traditional sense?
No, I mean, I basically most of my day is just meditation. When I sit in front of the screen, that's sort of my meditation. But if I didn't have that, I would certainly meditate, and I think that's a really good idea. But I'm very serene most of the time, so...
Seems very nice.
It's very nice to say, yeah.
I read about this concept the other day, and I can't believe I hadn't heard about it before. But there's a concept called risk homeostasis. Another word for it is risk compensation, I believe. Related to the concept of homeostasis, that you have an average baseline of kind of what you're used to doing. And that could be an emotion, it could be a thought pattern, anything. And in this case, it has to do with your risk tolerance. So in this case, it would be a person who usually takes a lot of risk. They have this kind of constant level that they're used to taking a lot of risk. But then for some reason, if they don't do that, then they'll want to take more risks fast just to get back into their homeostasis. And one example of this is that people who I can think of one example for you, and that would be if you're usually trading all the time and you're taking a lot of risk, or at least you're dealing with it, and then maybe you go away on a vacation for a week and you don't trade at all. Do you engage in extra risky stuff then?
No, not. I mean, I think people are generally divided into two groups. Either you take too little risk or you take too much risk. And I mean, there can be problems with both. If you take too much risk, you're going to blow up. If you take too little risk, you're not going to earn enough. But I don't have any. My problem is that I'm too risk avert. I mean, that's always been my big issue, that I need to push myself to take more risk. So I'm just happy when I don't have to take risk. But now I've gotten very used to it, so now it doesn't really bother me. But I do get. I mean, you've heard about the expression "hangry" when you're hungry and angry. My wife gets that a lot. I just tell her to go and eat something. But I get wangry, which is work angry. When I don't get to work, when I've been on vacation for a week or so and I get really grumpy, my wife just says, go and work now for a few hours so you get back into shape.
What development in the world are you really excited about? I mean, fourth turning is one thing, but are there anything else? Technologies, media trends?
Yeah, I mean, I think the whole it's a very interesting time to live in with the technology aspect now with the AI and everything, and so that's really really interesting to follow. Do you know Tim Urban?
Yes. Yeah.
Yeah, I heard about his DPU.
No.
He has this theory, which is just a mental construct, but he calls it death progress units, which is the amount of time you have to go forward in time to, or the amount of years you have to go forward in time to really just die of surprise. So if you if George Washington if he came from 1700s to today, he would basically die of surprise because of all the technological advancement. But if you go back 300 years from there, I mean, if 1400 somebody came there to 1700, he wouldn't die of surprise because it would basically be the same.
Oh, and even if you came from the Stone Age to the 1400s, you wouldn't die.
No, but maybe you have to go back even further. But the interesting thing is that DPU is always contracting and becoming smaller and smaller and smaller. So the question is, how farther would we have to go into the future to die of surprise? And maybe that's only 50 years or something, because it's just such an exponential path that we're on in the technological...
Is there anything particular in this development that you are looking forward to or hoping for?
No, it's just this whole AI stuff. I think it's very fascinating. I mean, just because I'm a lot of into machine learning with in finance and trying to predict markets with machine learning, I think it's machine learning is just a part of AI. So, but it's very fascinating with all the robots stuff. And I don't know if you watched the Falcon Heavy launch with Elon Musk. That was also pretty amazing. I mean, it's.
I like this story about how Google made this software that from scratch, with just the rules of how the pieces can move in chess, in 8 hours defeated all other computers, blew past everything.
Yeah, people make a big deal about AlphaGo beating the best Go player, but they had to program AlphaGo for many, many years with sort of a lot of input from Go players, and then finally they beat the best Go player. But then they made AlphaZero, which beat AlphaGo just from scratch, not knowing anything about. And that's really interesting with these new deep learning neural networks that have come along now that have totally blown away everybody in terms of making predictions.
You know, there's a book called Future Shock by a guy called Alvin Toffler. Have you read this book?
No.
It was written in the 1970s, right during the hippie era, sort of. Not hippie, but the spiritual era that you were mentioning before also. And that book is about the term future shock, that the world is moving faster and faster. Just like you were just saying now about dying about surprise. And I think this is something... It also goes back to what we were talking about with the fourth turning, where people want to have things simplified for them because they don't have the right models in their head. And I think this is a really strong trend that we're seeing, that people are becoming more and more future shocked because they don't have the correct patterns in their heads.
Yeah, I think that's very true. I have a fairly unconventional theory in this aspect. I'm going to be unpopular now again, because I have a theory that we're going to see a very strong shift in the relationship between males and females going forward. Because I mean, we had the women's liberation when they got the 60s and 70s and liberated women in terms of economics and sort of freed them from just being in the house, and they could be on the same level as men in terms. And they're not there yet, but fairly equal. But I think we're going forward when right now women have the sexual power, and I mean they have the decision to decide, so they still have an advantage over men. But that's going to change when we move into this whole AI future with robots, and men are going to be able to have sex without going out to the bars. So that's going to shift the whole power dynamics between men and women. That's my theory, and I think it's going to be about as big as the women's liberation in the 60s and 70s, but for men.
That's really interesting.
There are quite dramatic shifts in the relations between the sexes over the years. And this is one thing that Howe and Strauss talks about in the fourth turning as well. They have a slightly different view of it all, but they didn't know about AI when they wrote the book. No. They predict that just as you had a strong female movement around the Second World War and before, which then degraded into very strict separation between the sexes in the 50s and the 60s, and then you had the liberation and today's equal society, and then they predict that we're just about going back to a strict separation between the sexes again. But you're kind of predicting something quite different.
it's not going to be all bad. I mean, I think it's a good thing also, but it's going to change the dynamics a lot. I've talked a bit about this to women, and I don't think they're aware of this, really.
Do they want to be informed?
No, yeah, exactly. No, they don't agree and everything, but I have a hard time seeing how this is not going to happen, because, I mean, if you're a guy and you can basically get the same experience just for a fraction of the cost, and you don't have to face the humiliation of rejection and everything, why men wouldn't? That's not saying that relationships are going to stop. I mean, we're still going to get married, just like women didn't stop marrying men just because they had the economic freedom. I mean, we still have pair bonding. So
mathematically, I think I've read an essay on this, that if you just remove 1% of the men from this equation, then all the women will fight over the remaining men and give a tremendous amount of power to every man. And if the development you're talking about removes quite a few % of men from the equation, then the remaining men that actually are willing to take some humiliation and take some risk, they will have like paradise.
Yeah.
Or maybe it will be the exact opposite, that school systems will stop, they will have segregated school systems that teach women how to handle a man so they can beat the machines.
Exactly.
That's the true Turing test.
Yeah, exactly.
Yeah. Then you have true specialization in the education system.
Yeah.
Do you want to make a movie or write a book?
Well, I've tried to. I've always had a sort of big passion is to write a novel or a book, because I love reading so much. So I really wanted to. It was a dream when I was younger to become an author. But every time I tried, I failed. It's like I write 1 or 2 pages and I can't seem to get past that. So I actually started writing a lot of poetry when I was in my 30s, and that was really fun for a while. I wrote a lot, and poetry is a lot easier because it's shorter. You just write a poem and it's over, and it's so it's a lot easier than writing a whole book. But someday I hope to write a book. But I have actually a small film production company called Four Brothers because my 2 brothers are in the movie and the music business. So we've done one film together called the Studentfest in 2013.
Is it available online?
Yeah, you can get it online. It's based on our real experiences during when we sort of crashed student parties back in the days.
That's an interesting plot for a film.
Yeah. We want to make it very realistic, but
would you say it's suitable to watch as a pre-party?
Yeah, it's very good pre-party movie. I was hoping it's going to sort of get a sort of cult following, like sort of like the Animal House, something like that. It's sort of frat. It's a very fratty atmosphere in the movie, but it didn't do too well in the theaters, so I didn't get my investment back, unfortunately.
Have you seen the movie Project X?
No.
I think it's partly based on reality. It's about some high school kids that they organize a house party and 1,500 people show up. Anyway, that's also a good pre-party.
Yeah.
What kind of poetry?
My biggest influences were Pablo Neruda, the Chilean poet, and also Charles Bukowski. I don't know if you know him, but he's really cool writer.
He has a really cool background story also.
Yeah.
Working at the post office.
Yeah, exactly. And he just writes about women and being in bars and brawls and stuff like that. It's really, but I really like his stuff.
Do you want to show any of your poetry? Could I read it?
I got it published in an anthology in the US, but I think I had to pay for it to get it in, But it was this kind of system where you paid for your poem to get into the book. So it's actually published in a book now. I have it in my library.
Do you ever think you will write a book on business or some of your special ideas for viewing the world or trading?
Yeah, that's one of my dreams that I would like to do someday. That would be really fun.
Talking of books, you read Ludvig's book, right?
Yeah,
Breaking Out of Homeostasis.
Oh, yeah.
Have you two discussed that?
No, we haven't talked about it. But
did you like it?
Really good book, and I think it's a really important subject. So I recommend it to everybody.
Thank you. That's really nice of you.
It's.
Did you learn anything new?
Yeah, but I didn't know about homeostasis, the whole concept really before. So it's really interesting, and you think about it all the time, how to sort of break out from your sort of your own homeostasis when you get into it. And,
when Ludvig and I started talking about homeostasis the first time, I actually thought it was just a weird word that he came up with himself.
Oh no,
it's just make a word.
Well, I think you should look up the concept of risk homeostasis, because it
that's
really
a good,
builds on. You've read my book, so you know how it interacts with psychology and all that stuff. And this is related to trading. And it's really interesting when it comes to society also. That if you make society too safe, a lot of people will want to take stupid risks.
Exactly.
Just because they're born with a certain risk tolerance, and then they can't really express it in ways that are simple to them, and then they'll take stupid risks just to get back into their like natural state.
And that goes back to the whole issue with the central banks and the Volmageddon. Also, that's what central banks were trying to do: make people sort of forget about risk, and so people start doing all stupid things like selling vol, sort of crazy, and this.
There is an analogous concept to risk homeostasis, and that's vice homeostasis. The sum of vices is always constant. So if you stop drinking or stop taking drugs, then you'll start hitting people or something like that. That's humorous, of course. But I think it's interesting that you tend to, your personality tends to do just as much of everything at all times, unless you truly break out of that little box you're inside. And you have to stay outside the box for quite some time before it becomes your habit.
And also to redirect that energy or focus into something constructive.
Yeah, no, that's very interesting aspects of the homeostasis.
Do you believe that, this is a tough question, but I have to ask it. Do you believe that the nation state is still going to be around in 20 years?
Yeah, probably in 20 years, maybe not in 100 years. So, I mean, maybe we'll evolve to something better, more efficient than the nation state in 100 years. But I don't think in 20 years, but maybe sooner or later. Yeah.
But I mean, if the blockchain thing really took off with a critical mass, that would probably speed up the process of that.
Yeah, exactly. Yeah, you have a decentralized system. That's always good.
Then we can all go around like James Bond with those engraved rings.
That would be cool. And that's what I love about the whole blockchain crypto thing. It's sort of very interesting technology. So it's fascinating, but not as a currency application. But I think in many other parts it can be really useful in contracts and holes.
It's really psychologically appealing.
Yeah. Unfortunately, this whole sort of central bank mania has created so much pent-up pressure for speculative assets that's gone into cryptocurrencies and created this whole bubble. But I think it's a lot of analogies to the dot-com bubble, actually, where you see the speculative mania and you see sort of now there's more Coinbase accounts than Charles Schwab's accounts, for example. And then you see companies changing name to something with blockchain and their stock goes up at 300%. It's exactly the same thing as in the dot-com bubble. So I think it's going to play out sort of like that. Like a lot of dot-coms went bust. I think a lot of the cryptocurrency is going to go to zero, but maybe something will survive and then we'll have the internet obviously survived, so the blockchain is going to do that too, but in some other form.
Do you think we'll see another sort of media, kind of like social media,
in
the next maybe 10 or 20 years?
That's a prediction of the fourth turning also, that in the fourth turnings you don't really create any new technology or anything. It's more sort of management of the old technologies, so I don't really foresee any new media coming. I think we're going to build on what we have, but I don't think we're going to have sort of any. But I could be wrong. I'm notoriously bad at making technology predictions. When the iPad came out, I thought it was the dumbest thing I've ever seen. Now I have 50 iPads.
What do you use all those iPads for?
My daughter has a couple, and then we have for the house and for the sound system and everything. So.
Oh yeah, speaking of that, you used to have 8 screens that you were working with, and now you've gone down to 2, correct?
Yeah, exactly.
How did that happen?
One thing is that when you start out with trading, you're really fascinated with the technology, and it's really cool to have all these screens. And it sort of reminds me of when I started earning a little bit of money. I bought a red Ferrari because I saw Tom Selleck drive around with one in Magnum PI. Yeah, so I mean, that's sort of the same thing here. But then you realize, what do I need this red Ferrari for? I mean, it's not me. So then you go back to sort of what's true to yourself and what's simple, and that's sort of an age thing also. The older you get, you just want to simplify stuff.
So then you got a yellow Lamborghini.
Exactly, that was more me. I actually got a cream colored Ferrari instead. I thought that was my.
Going back to the screens, when you had 8 screens, do you remember what you had on each screen?
Yeah, I mean, I had the sort of different screens for different stuff, But what happened was actually they started breaking down. So and I just got sick of replacing them. So but then I figured out that I was just choosing 2, but I just needed 2. So there was just no sense in.
What about now when you only have 2? What's on them?
Well, I mean, I have one screen for the trading application where I execute the trades, and I have another one for the analysis and the charts and the risk Excel and the MATLAB and everything. So I tried to divide it up.
I only got up to 3, but when I had 3, I got tired of turning my head all the time. So I got down to 2, and on the one I had like stock market screens, and on the other one I did work.
Yeah,
in like Excel and Word.
Yeah, that sounds pretty good. I mean, I understand people who have a lot of screens that sort of have to watch every tick and sort of scalp in and out, and do really real time pattern recognition. But it's not my type of trading.
If we look back on your career, do you remember some different challenges from when you made your first $100,000 and then maybe 1 million?
Yeah, I mean that really came when we were running the firm, so I wasn't. It wasn't like a really big focus. We were just focusing on building a good track record and then getting the firm to grow and managing the money well. So yeah, it wasn't like a milestone. Oh, now I made $1 million. Now I made 2 million. It was very continuous, and we didn't really get to. We kept a lot of money in the firm, so even though we made because of tax reasons, we couldn't take the money out, so we had to keep it in the firm for 5 years. Yeah, it was really a lot on paper in the beginning, although the money was in the firm, but I couldn't get access to it. We couldn't take it out. So, but I mean, and also I've never sort of been super materialistic. It's nice to be able to travel where you want and have a nice car and house, but it's not very important for me with materialistic things.
Do you have a certain skill or competency that you would advise our readers or our listeners to learn for the future?
I mean, generally just obviously programming and computers and learning AI and machine learning is good stuff. But I think also sort of the creative side, if you can focus on that, then there's going to be a lot of demand for more humanistic skills in the future, I think, when robots take over most of the manual labor, stuff like that. But I think the most important thing that you have to learn is just to learn this grit concept where you would just try to persevere and have long-term goals that you try to achieve, and also know that even though you have passion for something, it's not going to be all roses all the way. I mean, I have a lot of times when I'm doing what I'm passionate about, but it's just boring stuff. It's just managing data or sort of logging trades or something that's not really. But it's part. I mean, it's part of my passion, but it's boring stuff anyway. And you have to be really just to be gritty and realize that it's part of your long-term goal.
It seems like you agree with my view that the most important thing you can learn is learn about learning.
Yeah, exactly.
And also, as in grit, learn about doing.
Yeah, learn about doing and just be learning all the time and be adaptive and also listen to your inner voice. I mean, it's like Steve Jobs says, you don't let the other people's noise drown your inner voice, and that's a good quote. I think a lot of people get caught up in what they should do or what other people expect them to do, and I hear a lot of people say, "But I don't know what my passion is. I don't know what it is." But I think if you don't know what your passion is, then maybe you haven't done enough trial and error, so you haven't gone out and tried different stuff. I mean, I tried a lot of stuff before I found my passion. You have to go out and try stuff and really be doing stuff, not just thinking about it. Or B, it could be that you're afraid of failure, which is very common. I think among people don't follow their passion because they're afraid to look stupid. And it's like sort of like the Elon Musk story I told you before about when he was 10 years old and explaining to a girl that he's not afraid of the dark anymore because the dark is just an absence of photons, so it's no reason to be afraid of the dark. And that sounds really cute when you hear it from a 10-year-old, but it's really true about taking risks in the adult life also. I mean, you're not going to die because you start a company that fails. You're not going to starve. Nothing bad is going to happen to you. But you think that's why people are afraid to fail, because they think it's going to be lethal, but it's not. I mean, it's just your ego.
When people learn about our interviewing you, they almost always say, ask him what motivates him to keep trading even though he doesn't have to. That's not a good question, since if you just want to quit what you're doing, if you just want to make enough money to be able to quit, then you're probably doing the wrong thing.
You have to love the process and not the outcome. I mean, that's the best way to get good at something, just to love doing what you're doing. I mean, I know when I got my first job at Nordea, I couldn't believe that they were paying me to sit there. I mean, I would have paid to be there. So I was just amazed. And that I think you have to be like that. You have to sort of love the process and not think too much of the outcome.
To make a brief recap of the stuff that you recommended, you said AI, programming, training your creativity, learning how to learn, and also being gritty and persevering. And so that's kind of like a neat combination there. Neat combination of things to focus on.
Yeah, exactly. That's good to be aware of them. Then I realized when I said that it's hard to sort of be. I think you have grit or you don't have it. I heard a study they did on kids actually when they gave them the option of a choice of 1 cookie now or 2 cookies in an hour, and the kids that chose the restricted way and said 2 cookies in an hour, they became more successful when they grew up. So focus on long-term goals and not to think too much about the short term, and not gratify yourself all the time like you do, Mickey. No.
They've kept doing that marshmallow or cookie test over the years, so it's been done.
Yeah, you read about it too. Yeah,
and they're getting better at it. The kids are getting better.
Really? Okay.
Yeah.
Okay.
You would think the opposite would happen.
Yeah.
I'll have to look up that research and I'll include it.
It's really interesting. I tried it on my daughter, but I don't think she passed. I'm a bit worried about that.
Have you tried it on your wife?
She's not going to pass.
You get 1 necklace now.
Exactly.
You must know a bunch of people who have succeeded in different things. If you look at what these people have been doing, and if you look at the skill set that they've accumulated, what sort of combination of skills do you see them having built up over the years?
I can hear you, Ludvig. I'm right here.
I think it's very different between everybody has their own set of skills, and it's hard to really make a general sort of statement about what skills are good and what skills are bad. But one thing that I know you guys talked about is this concept of being a giver and not a taker or a matcher. And you talked about the difference between those 3 personality types, and you should always just try to be a giver and help people, and then good things will happen to you. You shouldn't sort of expect anything in return.
That was a great way to finish this interview. Thank you so much, Martin, for coming.
Yeah, thank you very much for coming.
Thank you. It was an honor to be here.
Okay, so I hope you enjoyed this interview with Martin, and we've put together, it's about 15 pages, a summary of all the best stuff that Martin told us in this interview. And we came up with as many as 27 different really useful lessons. And if you want to get this summary with the 27 lessons from Martin, then you can go to our website, www.futureskillspodcast.com, and you'll find it. It's really easy to find. Or you can just look in this episode description and you'll find a direct link that we provided. And one last thing. If you enjoyed this interview with Martin, please leave a review on iTunes. That will really help us to get the podcast out to other people who otherwise might not find it.